Welcome to This Explainer. Today, we're doing something a little different. We are going to expose the actual underlying math that runs the financial world. We're stripping away all the loud industry hype, the flashy headlines, and that endless social media noise to reveal what really, structurally builds wealth. So let me start by asking you a question. What do a rocket IPO, the global bond market, and the mortgage on your house actually have in common? I mean, on the surface, they look like completely different universes, right? But as you'll see today, the bridge between massive global macro events and your personal bank account is actually a hidden, rigid structure of rules. We're going to look right past the CNBC opening bells and the shiny bank pre-approval letters to find the quiet, concrete math that governs money. Because whether you're buying a stock, financing a house, or saving for retirement, there is the story the financial industry sells you, and then there's the math they don't want you to see. Okay, let's dive into this. Here is our roadmap for today. First, the invisible financial engine. Second, the IPO hype machine. Third, the illusion of edge. Fourth, the housing affordability trap. And finally, number 5, the optimal wealth sequence. Let's jump right in. Section 1, the invisible financial engine, or essentially how bonds rule absolutely everything. All right, we got to start with the absolute macro foundation of all money. The global bond market is an estimated 130 trillion, yeah, with a T, dollar beast. It's way larger than the global stock market, and it dictates the true cost of almost everything in your life. And it is ruled by one ironclad law. When interest rates go up, bond prices drop. Always, without exception. Think about it. If you own an old bond paying 3% and suddenly new bonds start paying 5%, well, nobody wants your old bond unless you drop the price. This quiet, inverse relationship is exactly the dynamic that created the conditions for the Silicon Valley Bank collapse when rates spiked and the value of their long-term bonds completely cratered. And that brings us to an uncomfortable reality right here at home. $33 trillion. That is the size of the U.S. national debt. Just to put that into perspective for a second, if you physically stacked 33 trillion $1 bills, that pile would reach a third of the way to the sun. It's massive. For years, America borrowed this money at near zero interest rates. But now that huge debt is being rolled over and refinanced at much higher rates, which is costing the government over $1 trillion a year just in interest alone. Moving on to Section 2, the IPO hype machine and the reality behind the opening bell. Here's what nobody told you. Corporate media absolutely loves to distract us from this foundational math with pure theater. Take the euphoria of a massive public debut, like the SpaceX IPO. It is the perfect trap. You see the bell ringing, you see the stock pop 30%, and naturally, you want in. But the most important number for a new public company actually isn't its day one valuation. It's 90 days. That's the standard lockup period. It's a ticking clock where the laws of financial physics are quietly working against retail investors who bought into the hype. What's really interesting about this slide is that during this lockup window, early insiders, we're talking founders, private equity, employees, they are legally prohibited from selling. But when that 90-day clock strikes zero, the dam opens. As our source material describes it, there is an enormous pressurized volume of shares waiting to dump. Early insiders sitting on massive 10x or 20x gains from private valuations are just waiting for their chance to protect their exits, and that dramatically shifts the supply and demand overnight. Section 3. The illusion of edge. The Warren Buffett bet. So the IPO hype is really just one part of the ultimate market trap, this dangerous, heavily marketed illusion that everyday active trading and individual stock picking can reliably beat boring, quiet market indexing. Well, let's do the real math here. Back in 2008, Warren Buffett actually bet $1 million that a zero-effort S&P 500 index fund would beat a hand-picked portfolio of elite hedge funds over 10 years. Over that decade, the passive index absolutely humiliated the smartest, highest-paid managers on Earth, returning 125.8% against their meager 36.3%. No contest. So, why did the pros lose so badly? Because beating the market is incredibly difficult over long horizons. Get this, an astonishing 94% of actively managed large-cap funds underperform the market over a 20-year period. 94%. This is largely due to trading costs, taxes, and honestly, the simple emotional, psychological mistakes of buying high and selling low. And here is the secret to why indexing actually works. Over nearly a century of data, just 4% of stocks drove literally all the net wealth creation in the market. The other 96%, they basically performed like boring treasury bills. Indexing guarantees that you own that 4% of mega winners that drive all the wealth. Active stock picking, on the other hand, leaves you overwhelmingly likely to just hold a portfolio full of the 96% of duds. Section 4, the housing affordability trap, gross versus net income. Let's bring this macro math straight into your personal life and look at what is likely the biggest financial trap of 2026, the illusion of home affordability. And this brilliantly illustrates the problem. The banking industry tells you to spend no more than 28% of your gross income on housing. So for an 80K earner, that's about $1,867 a month. But here's the catch. Banks approve you based on gross income. They deliberately ignore the brutal, hidden realities. When you actually add in property taxes, homeowners insurance, PMI, and a very conservative 1% maintenance reserve, the actual cost balloons to over $2,700 a month. And when we calculate that real cost against your actual net take-home pay, the numbers are terrifying. Our $80,000 earner actually ends up spending a suffocating 54% of their net pay on housing. 54%. And that's before buying a single bag of groceries, paying for childcare, or handling literally any other bill. The math they approve you for and the math you actually have to live with are completely disconnected. Oh, and that 54% doesn't even account for the invisible costs that show up on move-in day. We're talking closing costs that demand thousands in cold hard cash, moving expenses, the move-in gap for things like appliances and lawnmowers, and of course, the deferred maintenance bomb. You know, like the absolute joy of your water heater randomly exploding in January, or sudden subfloor rot. If you haven't mathematically accounted for these hidden costs will wipe out a new homeowner's emergency fund immediately. Section 5, the optimal wealth sequence, or the financial ladder. All right, we've talked a lot about the traps, but let's pivot to the empowering solution. Because getting wealthy isn't about picking the right stock or stretching to buy a house out of FOMO. It's actually about following a precise, structural sequence of how you deploy your money. Let's climb the ladder. Step 1, a starter emergency fund of about $1,000 just to prevent catastrophic early liquidations. Step 2, get the employer match on your retirement account. Listen, this is a guaranteed 100% return from your boss on day 1. Take it. Step 3, eliminate toxic high-interest debt, because absolutely no investment is going to be a guaranteed 20% negative return. Step 4, max out a Roth IRA, which offers millions in totally tax-free gains over your lifetime. Step 5, go back and max out the 401k for tax relief. And finally, Step 6, build out that full 3 to 6 month emergency fund. The crucial point here is this. Sequence matters way more than instinct. A person with an average salary who strictly follows this sequence will almost always outperform a high earner who skips these steps to chase hot stock tips, crypto trends, or housing FOMO. When you skip the sequence, you forfeit compounding returns that you will literally never, ever recover. I want to leave you with this final provocative question to chew on. Are you building your wealth on the loud, flashing financial hype sold to you by an industry that profits directly from your confusion? Or are you building it on the quiet, structured, real math? Rely on the math, stick to the sequence, and turn down the noise. Thanks for joining me on this explainer, and I'll catch you in the next one.